It's January the 30th, 2008. This is your Active Trader newsletter. Taking a look at our S&P 500 index proxy, we have an interesting proof of my theory that the tape never lies. I always am of the opinion that market intervention by governments can, while provoking short squeezes and other short-term market anomalies, really can't do much for the overall money tide in the markets. And if there ever was proof, it has been the last couple of weeks. Here we have a market that's just selling off massively, and then the government comes in, pops a three-quarter rate cut on this day and half today, and does absolutely nothing but accomplish one of the nicest and most powerful sell signals I've seen in a very long time, a rally to resistance. I don't know if you were watching the market intraday, but there was an absolute slathering pack of bears waiting to sell into that spike after the Fed. It was pretty epic from a tape reading perspective. Just loads and loads of what I believe were active short sales swamping any of the buyers. So with that in place, I would expect that the rally is dead and the market's probably going down for either a higher low or a retest. Not really sure yet whether I believe that the market's going to crash on lower, building another wave to the downside, but I certainly think we're in for a rough ride in tomorrow's session. Perhaps the most violent potential would be a strong gap reversal, where we gap down fairly significantly and then come back up, forming a higher low in that way. But for now, I'm interested in short exposure, taking off long exposure, and repositioning myself. We got long and we nailed the bounce beautifully. Couldn't have been any nicer in terms of timing. Now I think it's time to take the money and run, get some short exposure open, and begin fishing to the short side, seeing what the market can deliver as it does fall back down for perhaps a retest of the lows. So one of the best patterns I see out there actually is that of the daily chart of the diamonds, the Dow index proxy. So you can see here, clean rally to resistance. It's come up into areas of chart resistance as well as moving average resistance and has rolled over. In interest of full disclosure, I would let you know that I've actually already taken my personal position in this. Took it when I saw the tape flip over intraday after the Fed announcement, using the YM, the index futures, as my index proxy. But nonetheless, based on an end-of-day data level, the pattern is very, very solid. We've got a massive rally to resistance after some chip chop here,